Good morning, everyone. Well, better than expected manufacturing PMIs from the Eurozone contrasted with a shockingly weak ISM index from the US to send the dollar lower against most of the G10 currencies. Anecdotal evidence still suggests that the apparent slowdown in the US is really a weather story. Nonetheless, the market's clearly worried that there's more to it than simply the weather. Implied interest rates on the long-dated Fed funds futures are now slightly lower than they were before the Fed started tapering. This indicates that all the expectations of Fed tightening have been unwound and then some. Naturally, this unwinds some of the interest rate support for the dollar, too. Curiously, the euro wasn't a major beneficiary of the move, as euro-dollar was only slightly higher. This was probably because of lingering thoughts of possible loosening measures at this week's ECB meeting. The big gainer was the Australian dollar, after the Reserve Bank of Australia changed its policy statement to a more neutral view. Previously, the RBA had said that it would adjust policy as needed to foster sustainable growth, a statement that held out the possibility of rate cuts. They changed this to the most prudent course is likely to be a period of stability in interest rates. They also dropped references to the currency being uncomfortably high, which indicates they're pretty satisfied with current levels. This could be the bottom for Aussie dollar. On the other hand, sterling lost significant ground against all currencies, including even the weaker dollar, after its manufacturing PMI missed expectations. This was notable as the size of the miss in the UK was nothing like that in the US. It's odd that the pound should get hammered so badly on such a small miss. The market may feel that while the UK economy is indeed recovering nicely, the recovery is now fully discounted in the price. So while I've been bullish on sterling, I now recommend caution as the large reaction to the small miss suggests a change in market sentiment. Today we've got the UK construction PMI for January. The index is forecast to have fallen, which could put further pressure on sterling after Monday's disappointing manufacturing PMI. Elsewhere in Europe, a slowdown in Italian inflation may add weight to the scenario that the ECB could take further action on Thursday. From the US, factory orders for December are forecast to have been down 1.8% month-to-month, a turnaround from the rise in November. This would be another dollar negative number following Monday's terrible ISM figure and could put more pressure on the dollar. For more information, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.